Chris Kantos makes money from your social media posts. Kind of. He works for Alexandria Technology, a company that applies natural language processing to turn earnings calls, news, and Reddit posts into insight for systematic hedge funds.
How are you capturing information that is coming into the market? You do need to use things like NLP, AI.
Their technology processes 1.7 million global corporate events daily and is used by organizations like JP Morgan, Interactive Brokers, and SocGen.
What was 2008 like from a quant, particularly in risk management?
It was silly how easily it was to forecast that these companies were going to default. The company that I worked at did the math to figure out that Bernie Madoff was a fraud. The signs were there if you wanted to listen. I think a lot of it is people putting their head in the sand.
Chris, thanks so much for doing this. Let's say I post on Reddit about a stock. How does that post become actionable alpha for systematic hedge funds to trade on?
Well, thanks for having me, Ethan, and that's a great question. And I think, the crux of the matter here is how do I turn that textual post, which is unstructured data, into structured, actionable insight? And one way in which you can do this is by using AI or NLP to transform that into structured data. Then once your institutional investors have this sort of structured data, you can then build a factor that can be orthogonal to your traditional data sources to capture that alpha.
And so what sort of data sets does Alexandria currently offer? Because obviously with text data, there's tons of different types. I just mentioned Reddit posts. There's obviously earnings calls. Would love to hear more.
Yeah, definitely. So currently, Alexandria analyzes many different financial data sets. We cover news sources, ranging from Dow Jones, Benzinga, MT. We actually have a proprietary relationship with Nikkei to do native Japanese classification. So we're not doing sort of any translation there. And then you sort of have longer form documents, and it all depends on sort of the application that you're using it for. Are you trading intraday? Are you trading daily, monthly, quarterly even? And so the longer form documents tend to be better for strategies that rebalance at a much lower frequency. And with this, as you mentioned, we do cover earnings calls. One of the data sets in which we've recently begun to analyze is SEC filings from the Edgar database. And then we do have other various data sources, like you mentioned, as well, social media, Reddit specifically, as well as web-based news. And it is, I will make the caveat as well. We're covering news from various different sources, and we do cover that across all asset classes. So we're not just looking at equities, but also in the macro space, commodities as well.
So obviously, alternative data really only popped up, let's call it the last 10, 15 years. And there's a lot of talk about, since a lot of hedge funds use various sources of alternative data, I guess one could question whether or not this data could become commoditized. I'd love to hear how you think about that, because in my view, if all of these different systematic hedge funds, let's call it, the big multi-managers or, Jane Street or Citadel, if they're buying all the same sets of, all the same data sources, they could be constructing similar models. I'd love to hear your thoughts on that.
Yeah, no, and that's a great question, and obviously a concern among many investors. And so let's take a step back here and look at sort of where especially NLP came from. So you started off with your very basic rudimentary models, things like Law from McDonald, which basically you're using a dictionary-based approach to, analyze text, pick out keywords and base your sentiment off of that. Now, I think it's pretty common agreement in the marketplace that Law Firm McDonald dictionary-based approaches have been arbitraged out. So pretty much no one's using that anymore. And, we do get this question a lot, like, have you seen alpha decay? Is this being arbitraged out? Is the signal being arbitraged out? And we actually have not seen that within our data set. And one of the things that we continually try to look at is correlations between other approaches. So how correlated is like a FinBERT? How correlated is our approach to NLP to something that, I think investors have agreed has been arbitraged out, like a dictionary-based approach? We still see very low levels of correlation, at least with our approach, to the various other, whether they be open source or available from other providers, do see a low correlation. And I think the big difference from that comes in your approach to training your model. So let me give you an example. So say you're trying to analyze earnings calls. And as I mentioned, you're trying to take that unstructured text and turn that into structured data. If you're using an approach like a dictionary-based approach, like Law Firm McDonald, you're not really using the right tool. Law Firm McDonald is not trained on labels from earnings calls, which you're trying to analyze. So then maybe you say, okay, let me use something like a FinBERT, Google's BERT, complete workhorse of a deep learning, which is tailored for the financial domain. But then again, you have a problem here as well, where FinBERT's trained on news data. So again, you're trying to classify a document with the wrong training data set, or a model that's trained on the wrong training data set. And so I think, you do have all these diverse approaches, each with their own input for training data. And that's where you see the big differences. So you could have two approaches to NLP, both analyzing the same document and with drastically different results. And that's where I think, Alexandria still has an edge and has not had to worry about, the alpha decay, the crowding, things like that.
What separates Alexandria's approach to, I guess, their training data? Because you mentioned, low correlation to even other data providers. What makes Alexandria different?
So I would say, like, in addition to like the machine learning and NLP models that we have, as you mentioned, it is a lot to do with the training data. So for each of the financial documents that we analyze, could be news articles, it could be earnings calls, it could be social media, we actually have a specific training corpus that is actually derived from that document type. So we don't use our news classifier to classify earnings calls. We actually have a specific classifier for earnings calls. And it makes a big difference, right? So, you take an example where you have a third-party reporter saying XYZ company is doing great things in sustainability. They're certainly, emerged as leaders in their field. That's going to definitely be positive sentiment. It's a third-party independent reporter. Now, say, for example, a CEO gets up at the beginning of an earnings call and says, we have the best team in the world who are working on the most sustainable projects in the world. It's like, sure, of course you're going to say that. This is your company, and you want to, make nice. And so those slight nuances where you might get it wrong if you're not using the exact document type that is for that document and for that domain. And so I think that, sort of is the big difference between Alexandria and a lot of other approaches, is we do take care to make sure that we are using that training data that is specific for the task at hand. And that sort of like applies across to these other models, which are trained on vast amounts of data. So, you think about something like a ChatGPT, for example, and I'll make a caveat and say like a ChatGPT right out of the box that has not been fine-tuned or anything like that. Just because ChatGPT may actually have been trained on earnings calls, it's also trained on the rest of the internet as well. So it can be overly optimistic. It's not great at the specific task at hand of looking at specific documents, at least for investment purposes.
Let's say you're speaking to a systematic hedge fund manager and he's interested in one of your data sets and he's concerned about perhaps a lot of other various systematic hedge funds using it and the edge essentially not being there anymore. What would you say to them?
Yeah, so I think one of the big things, and I think this is true for most data providers, is that you're not selling a signal and you're selling a tool in which they can add as a factor into their multi-factor process. And I would say that most people are not building this factor in the same way. Or actually using it for the same reasons. So, when you talk about sentiment analytics and things like that, almost all of it is discussion around, alpha generation. Actually, prior to joining Alexandria, I actually was a client of Alexandria for about 8 years, and I was using this data for forecasting volatility. And so there is, we're just providing this alternative orthogonal source of data that is more contemporaneous in the marketplace than your traditional data sets that you can sort of build any type of factor that you would want to build.
Where do you think most edge will come from within the text domain for the buy side going forward? So I don't know if that's like further sentiment, maybe applying this new technology, all these large language models to capture maybe more nuance. Would love to hear your thoughts.
Yeah, I mean, there certainly has been tons of research, and if you look at like the number of research articles that have been published, like since the advent of generative AI, it's completely exploded. And but since pretty much from day one of like looking at things like news articles as a contemporaneous information source of information, it's exactly that. How are you capturing this information that is coming into the market instantaneously that perhaps has not been priced into the market yet? You do need to use things like NLP, AI, to be able to add that as a factor in your model. And I don't think that's going to change. That being said, kind of like I was veering off from your question a little bit. Absolutely. Like companies are running their earnings calls through these models beforehand, tweaking them to make sure that, at least like these types of, algorithms may not be picking up on what they don't want them to pick up on. And so like, but as that gets more and more sophisticated, so must the training data that these models are trained with. Because it's exactly that. Like even now, executives will use quite a few different buzzwords. And I know I keep going back to the earnings call example, but yeah, using buzzwords in an earnings call that they know like something like a dictionary-based approach will pick up as positive. But if you have the correct training data set, that's more a neutral or even like avoiding question. And that kind of goes back to what you mentioned about like worries about this being arbitraged out in the market. And if you look at something like corporate filings, 10Ks, 10Qs, and I think it's probably over 20 years ago at this point, there was a paper called Lazy Prices. And basically what they were doing was comparing the risk factor sections from one quarter to the subsequent quarter. And what they found was the larger the difference in the language in the risk factor section from quarter to quarter was indicative of future negative financial performance. And so basically, if a company just copies and pastes their risk factor section quarter on quarter, like you feel good about that company. This is another thing that sort of has been arbitraged out in the market. People have been looking at that for a long time. But again, it just kind of proves to your point, like, what are people doing now? What are people caring about? It's like, oh, wow, maybe we can gain an edge by looking at the length of different filings. So, especially with AI, sort of like the sky's the limit on like the number of dimensions you can look at a piece of financial text with.
How are things that, I guess, let's say it's an earnings call, and let's say it's how are nuances like tone captured in processing these data sets?
Yeah, and so like that's one of the research projects that we're currently working on is actually analyzing the voice. Currently, or at least historically, we had just been looking at the text, the actual transcript of the call. But yeah, that's just going to add another dimension on top of that. To be able to find out, has the voice lowered, has it raised, can you sense tension in the voice, things like that. It's, again, just going to add another dimension of analytics that investors are going to be able to exploit.
Going back to what we were talking about with regards to LLMs and I guess, agents as well, within that category, where do you think, or rather, where do you think these technologies have a place within the processing of a corpus of text for trading?
Yeah, that's a good question. So, like, up until now, I've actually not come across many that are using this for trading decisions. Certainly like analyzing, synthesizing, simplifying text into some form of structured input into a model. I wouldn't say that like specifically for something like stock selection, certainly not trading for you. I know there's been a few research papers that have tried this. Like, I won't comment on those, but I think like we're still getting there, and it certainly has its place, but especially on like the trading applications, I don't think we're there yet.
Fascinating. I want to talk a little bit, Chris, about your career. So you worked in risk for a while and then transitioned to the more data side to, ultimately selling data that, firms try to translate into alpha. And within that, also working on, translating your own signals into alpha. I've been seeing some of your LinkedIn posts talking about, some of the stuff you're doing, talking sharp ratios of around, I think it was 1.5, which is, very good, mind you. Why did you make that transition, and are you happy with it?
Yeah. So, I sort of got into the quant world in a sort of a unique way. When I was at uni, it was basically I saw this poster on the wall, and it's like, do you like engineering? Sure. Yeah, of course. Do you like physics? Yes. Do you like mathematics? Yes, of course. Are you vaguely interested in finance? And I was like, yeah, I guess I could be. And then it's decades ago at this point, and I went to a conference called How I Became a Quant, and met the CEO of a company, started interning there, and sort of the rest is history. And so, yeah, I was actually working on risk models, volatility forecasting. And so actually how I came across Alexandria was basically we were building risk models with like a 1 year forecast. And what we wanted to do was shorten that horizon to something around a few weeks. Didn't want to use higher frequency return data just because of all the issues with that. So at the time we were using things like option implied volatilities, the VIX, to sort of like condition our risk estimates for a shorter horizon. And we thought, what if we used news data? Because this is like kind of this cool new thing that people are doing. Like it could be a novel approach. And after some research with different providers, I came across, Dan Jolzik, the CEO of Alexandria, started looking at their data set and found it to be the most robust. And it actually was a more efficient forecaster of volatility for various reasons, like option markets have trading costs, things like that. So we actually put into production this sort of risk system that was incorporating contemporaneous text analytics to condition risk estimates. And so Dan and I became friends. We spoke at many conferences, and the opportunity to join the team sort of came about. And so it was a hard but fun decision to join the team at Alexandria.
What are some of the difference between working as a quantitative researcher within risk versus, more on the data side of things?
Well, I guess it's much more talking to people, which is fun. And yeah, it was kind of a big transition from, being the person that no one likes, which is, the risk deep. You're talking about alpha generation. So it was sort of a big switch, but a welcome one.
I want to hear more about risk because, having worked within, quantitative risk management,
Mhm.
um, I think a lot of issues, I would say fundamental investors have with a quant's approach to managing risk is this idea that you don't know what you don't know. And so, I'll give an example. Maybe 2013 or 2007, where we have the quant quake. Obviously, during that time, quants were still very sophisticated, still very much monitoring, their positions. But, a lot of these strategies essentially got crowded and no one realized. And even with regards to, let's say, the extensive risk management protocols that are present at these large multi-managers, and monitoring all these different factor exposures, and then levering up. I guess from a fundamental investor's perspective, one can still look at that and say, okay, even though your volatility is, let's say that of the market, if you're 5x levered, right, even if you've hedged out everything, you don't know what you don't know. And so, like, are you truly managing risk? And what happens when an extreme event comes that you never forecasted? What happens when that comes and essentially maybe topples all your positions? And I'd love to hear your thoughts on that.
Yeah, and I think, I wouldn't almost say that it's not you don't know what you don't know. It's like you choose to ignore what you choose to ignore. And like, having worked, especially at, the company that I was previous at, like we were privy to a lot of these very large events. The company that I worked at sort of did the math to figure out that Bernie Madoff was a fraud. The collapse of Credit Suisse. We were like, hey, we had this for you right here. And so like the tools are available. It's just whether or not, risk managers are allowed to sort of like implement them. And so like when you say, you don't know what you don't know. I think a lot of it is people putting their head in the sand and choosing to ignore the fact that you're making this exception to lend out this incredible amount of money just because they're a friend or something. And so there are approaches to making sure these things don't happen. I know this is like something that's, well documented and is nothing new, but it's like, returns aren't normally distributed. Like, don't make an assumption that returns are normally distributed. And then, I don't even want to get into this, but you have all sorts of issues with like VAR calculations. Like these big banks should not be using VAR calculations. They're like inherently flawed. But, certain regulations require that you report on VAR. So everyone has to do it. And they're like, well, maybe this is good enough. But for the most part, it's not good enough. And, you should be taking more care in, looking at your positions. And, I think the argument for taking more of a quantitative and statistical approach is that you can find relationships and correlations that you might not be able to using sort of a more fundamental approach.
Tell me a little bit about how your last company determined Bernie Madoff was a fraud.
Well, interesting story. So, Harry Markopolis worked across the street, and he came over and he's just like, guys, this doesn't make any sense. Like, there's this manager, let's call him manager B. And we run the exact same strategy. I can't find any big discernible difference between what we're doing and what they're doing. But this other manager just never loses money. And so like, sat down and the former CEO, the CEO of my former company, spent a few hours analyzing returns and things like this. And he's like, well, there's several possibilities here. One, they're running just a completely different strategy than what they're telling investors, which, would be bad, but not like, the end of the world. Two, like, this is possible that, they are beating the market, roughly with the same strategy. The odds of that are about 1 in, 22 million. And then third, they're just making up the returns. And, thought nothing, our CEO thought nothing of it. Harry goes away, like 15 years later, comes back into the office and he's like, finally got him. And, it turned out to be Bernie Madoff. So, that was an interesting day in the office, for sure.
You started interning at your last company in 2006. So you were there in the office when that happened, right?
Yes, I was. It was quite a day. Harry ran into our office, grabbed a bottle of whiskey, and then the reporters were all at the door.
Wow. What was 2008 like from a quant, particularly in risk management? And I ask that question because obviously it was quants who bundled up all these different products to sell, which were obviously, trash. What was it like?
Yeah, so it was interesting. And of course, kind of going back to the point of you're going to ignore what you want to ignore. And interestingly enough, we had built a probability of default and a loss given default model using Alexandria's sentiment data. And it was silly how easily it was to forecast that these companies were going to default. And so we were using this news sentiment data along with our risk data, again, to forecast probabilities of default. And you could just see like the financial services companies were skyrocketing prior to like the crash happening. And so, yeah, it's like the signs were there if you wanted to listen. But you know, it's easier to look in retrospect and say, oh, shoot, you should. But you know, it certainly was an interesting time, especially when people are like, we really need to, you know, up our game with our risk systems. And you know, everyone panicked about that for a while, and then some did, but a lot didn't, unfortunately.
This channel is, geared towards people interested in quant trading and risk and understanding probabilistic decision making. And right now, we're going through a period where there's so much change that's happening. I don't know if um, I don't know if it's affected the way your company's hiring, but just a lot of huge firms that previously offered very high quality white collar jobs to intelligent university graduates. A lot of those companies aren't offering them anymore, or at least downsizing their intake of, let's say, their class of interns or class of analysts, first years, juniors. And I'd love to hear your thoughts on what this means for the way young people today should navigate the career.
I mean, I think that's a, you know, that's a good question. It's like you can't, you know, in my opinion, you can't only hire senior people, like because they're gonna eventually go away and you know, move on. But I think, you know, navigating as a young graduate certainly has gotten more and more difficult. But you know, I think it is still the same, like learn the skills that you think are going to help you. You know, coding, which of course is sort of at risk as well with you know, generative AI. What I think Meta just said that they're going to let their coders use generative AI during their interviews, which I thought was quite interesting. But you know, opportunities are still there, and you know, it may not be the ideal role that you thought you were going to go into right away, but there's many opportunities out there, whether they are, you know, specifically in financial services, more on the tech side, that are still open to get your foot in the door.
And given your background in risk and now servicing a lot of systematic asset managers, are there any risks you see that could present themselves for a lot of these firms that perhaps they don't see?
Well, I think like one thing where we are, you know, in discussion with a lot of asset managers and asset owners is, you know, they are stuck with large investments in one specific, you know, generative AI company. It's sort of like picking your horse and crossing your fingers that it's the right one. And you know, I see that could potentially be a problem. We again talked with several large asset managers, and they're like, "We love what you're doing. We love what other people are doing, but we're locked in. Like we are completely locked in to, you know, XYZ, and there's nothing we can do about it." And so, you know, I think that potentially could be an issue where, you know, you're locking yourself in and not being able to exploit other things that are available in the marketplace, which your competitors might be taking advantage of.
And having worked in this space for several years, uh,
Mhm.
which data sets do your clients tend to find most valuable? Like, what are the most popular ones that they tend to use? And I guess, on top of that, specifically for generating alpha.
Yeah, no, that's a great question. And uh, I guess the question really comes down to use case and your trading horizons. Um, Something like a news article is going to have quite a bit more alpha decay, because you're reporting on something that's already happened. So like you need to capture that sort of orthogonal alpha that's coming from the news very quickly. And then it could also be, that decay is also like a function of cap size, how well known the name is. Like, Ethan, could you even tell me about any news from NVIDIA 2 weeks ago? Probably not, because there's so much in the last week. So like, the news about NVIDIA from 2 weeks ago, like, does not matter, because every day you're getting new news about NVIDIA. And so you really do need to capitalize on that quite quickly. So for investors that are trading, intraday, daily, few day holding periods, like that news data really gives you sort of an edge, because like, hey, like you're not holding until next week. So like you want to be intaking this news information as quickly as you can, and acting on it. Now, say, for example, you're an asset owner and you're only looking to rebalance, maybe every month, maybe every quarter. You don't really care about like the fluctuations that happen in the news, like that are being captured by the shorter term traders. Like you care about the longer term outlook of the company. And that's where things or data sets like earnings calls are very valuable for alpha capture. So earnings calls have a tremendous amount of drift, a very long-term alpha decay. And we've seen this, like we've actually measured it. And the hypothesis that we always had was that, earnings calls are not just about reporting about the previous quarter. They're also about what's going to happen in the future and plans for the future. So, you have the CFO of a company saying like, well, revenues were down in Q2. However, with the summer season, we're expecting, customer demand to increase, which we'll see over the course of Q3 and Q4, revenues slowly rise. And so it's like your backwards looking statement was negative, but your forward looking statement was actually positive. And that's sort of where this long-term alpha comes from. So we've actually done, like in some of the tests that we ran, like we don't even trade in our simulations because we're not trading. We actually don't even trade on the day that the earnings call happens. We could be trading a month and a half after the call happens and you still see value. And as I mentioned, we do think that it's because of these forward-looking statements. And so we actually just built a separate classifier to identify forward-looking statements within an earnings call. And so what we did was run our strategy, which we saw a Sharpe ratio rebalancing monthly about 1.2. If you just use those forward-looking statements, that Sharpe ratio increases to about 1.7. So like pretty significant value just looking at these forward-looking statements. So back to your original question, like which data sets are most valuable to institutional traders? If you are on the shorter term side, news data tends to generate quite a bit of alpha. If you are on the longer term side, rebalancing monthly, these longer form documents like filings, earnings calls, generate a very healthy amount of alpha at those rebalance frequencies.
I want to hear a bit more about your sentiment data sets, just because, particularly Reddit,
Yeah.
back in 2021, when we saw the whole, let's say, GameStop, saga, we saw that whole thing play out.
Yeah.
I'm curious how models like the ones you've developed at Alexandria would
capture that? Or were you able to turn it into an actual insight to, and an actual data point that indicated like overwhelming positive sentiment?
Yes. So the Reddit data set's really interesting. So we started looking at Reddit, oh gosh, probably almost like a decade ago. And we did our original tests. We're like, can we find value in this data? And we didn't really find anything. So we kind of, put it off to the side, put it on the shelf. And, so as you started getting more into the meme stock craze, we like talked to our engineers. And we're like, are we still you like running Reddit data? And like, yeah, we never turned it off. And then we looked at it and we're like, holy crap, there is a ton of valuable insights here. And yeah, you were able to capture that sort of that retail sentiment on what might be the next short squeeze, which was really cool. And even though like sort of the hysteria has calmed down, there's still incredible insights within looking at the retail sentiment data. And I know I just posted something on Reddit that was not super informative, but like we did a research project before where we were looking at like retail sentiment momentum and then looking at which companies had the highest outstanding short interest so that you could see basically like what potentially might be a candidate for the next short squeeze. Of course, if you are a hedge fund that has a very large short position in one of those companies, this might be very valuable information for you to have. You're like, the retail sentiment is rising quite rapidly on these securities that we have short positions in. Maybe we should do something about that. So yeah, in short, we definitely were able to, capture all that information, and it continues to be quite valuable. And as I mentioned, like we do have like separate training data set, just because to my knowledge, like people aren't using emojis in their earnings calls or in news articles too often. So it was quite an interesting engineering exercise as well. You think about even entity recognition. Like people aren't exactly using Bloomberg tickers when they're talking about a stock on Reddit. So like, how do you reconcile that? So that was an interesting problem to tackle as well.
That's fascinating stuff, and I think I guess that's the most obvious use case of sentiment data on social media, in particular Reddit, particularly for discretionary fund managers who have these short positions. And then also what you mentioned about, going back to the training data aspect, and you noting the fact that obviously people aren't using, all formal language and, like this, it's not the same type of language one would be using in an earnings call. That's also something that's something new that I haven't heard before, even though it is obvious.
Yeah.
I do want to hear about, more about these social media data sets, because I think, like, I remember when I was in high school and I was interested in quantitative finance. Some of the projects that were out there on how you could learn this skill were, Twitter sentiment for trading, or Reddit sentiment for trading. And um, I found that when I was trying it out, and obviously it was very unsophisticated way of doing it, and definitely not on the level of Alexandria. I found most of it to consist of a lot of noise, in that plenty of retail investors, let's say on Wall Street Bets, talking about this one stock that they like. It doesn't really amount to much because you have, their account sizes are much smaller than institutional. They could just be chatting. There's no real evidence of them placing, let's say, the amount that they've traded on the trade. And so I'd love to hear from you. How do you deal with that data such that it's not all noise and that you can truly generate
Yeah.
actionable insights from it?
Yeah, no, that's a great question. And you missed one obvious thing too, bots. So like, there's an incredible amount of noise in a lot of these data sets. And we had looked at Twitter as well. And we found Twitter was too noisy. And I think if you were to revisit that now, it would probably be even worse. So, yeah, I have no comment on that. But, we did find that there was a sort of meaningful, if you looked at specific runes on Reddit, like a meaningful amount of substantial information that was coming. Now, one thing that we've looked at doing as well, which is an approach that we use for like all of our simulations, is to figure out importance or weights to different topics, different sources, different users. And like, the most simple way you could do this is run a simple regression. Take your sentiment, and you could have your sentiment bucketed either by topic, by source, by what have you, and then regress that against your forward return, which would be your Y variable, to figure out source weights for each of your sources, each of your topics. That way, when you are sort of constructing your signal, constructing your factor, you can underweight the noise and overweight sort of topics and sources that have an impact on price movement, have an impact on movements and volatility.
One of the things you mentioned that was funny is that, on Twitter X, there's just so much noise. And, it's not, and one of the things that I'm thinking about now is that it's not even just retail guys on Twitter that are generating the noise. It's, even professional investors, venture capitalists who should be more sophisticated. Like I just saw a tweet the other day where Chamath talked about, a 5-year short case for Meta and for Google. And obviously, if you had ended up doing that, you'd have lost probably your entire account, if not more. If you'd put all of you, like it would have been brutal. It would have been brutal. And I guess this is a question more about it's more a general question, advice for young people. How do you cut through the noise today? Because it seems like there's so much, and you've worked in, you've been in this industry for so long, and I think what makes you have an interesting idea, would have interesting takes on this, is that your day-to-day job is dealing with noise. And so how do you filter out good information from bad information? How has your systematic approach affected the way you view the world and the way you filter out noise from your everyday life?
I mean, it's difficult. Like there's no way around it. Like our entire ecosystem is filled with noise at this point. Like noise, untruth, people just saying whatever they feel like saying. And yeah, I think it is making sure that you're looking at the right sources. Like I know that there are data sources that do similar things that like derive source importance from like Twitter users and are distilling on that. And so like making sure that you're looking at a viable source of information, like, as the old saying goes, garbage in, garbage out. So like if you're looking at garbage sources, you're going to get garbage results. And so like making sure it's one of the things that we do, exactly like you mentioned, our job is dealing with a lot of our job is dealing with noise, and we see that in data sets that we look at. Like, sure, could we analyze every single financial piece of text that we come across? Absolutely, but like, is it meaningful? Does it help investors capture alpha? If it doesn't, like we're certainly not going to put that into production and offer it to people. So it is, sort of a being very careful about vetting the sources that especially you're taking investment advice from.
You've worked, you're working extensively on the data side, head of quant research at a, very established data, data vendor, particularly for NLT, text data that's been processed.
I'm sure you could go and work on the buy side and perhaps, make more money just because people on the buy side tend to, take on risk and make money by, as a result of that. What stopped you?
Uh, Alexandria is a wonderful company, and we're doing really cool things. I, wouldn't necessarily trade a larger salary for accomplishing the things that we're doing at Alexandria. So it's a lot of fun. We're making really cool products. We have a great team. So I'm very happy where I'm at right now.
Last question. From everything you've learned in risk management and, on the more data side of quantitative finance, um, dealing with all this different text data, filtering out all the noise, truly trying to find signal, what is something that you've discovered, something you believe to be true, can be in life, can be in the markets, something you believe to be true that most people would disagree with you on?
That's a that's a really tough one. Um, you know, uh, well, I could go back to the like original ones, like we were already discussing, like VARs crap, things like that. But I'm trying to think of something, a little bit more. Um, yeah, you're putting me on the spot here. I'd have
No worries. Take your time. Take your time. Take your time.
yeah. So, um, uh. Yeah, I mean, it is like I mentioned before, like when you don't always take things at face value. You could you're reading a research paper and you think these ideas are great and you might want to go implement them. You know, the most important thing you need to do is check the assumptions. And so like I guess if there's something that don't always take things at face value. Check the assumptions, and most of the time you're going to find something wrong. Especially, if you are at a quant conference and you see the hockey stick, there's something going on there that, the assumptions that they're making, are they including transaction costs? Are they, what type of distributions are they using? Not everything's normally distributed. And so I guess that's, it might not be like something everyone would disagree with me on, but I think one of the most important takeaways is to, always check your assumptions and don't take things at face value.
Wonderful. Thank you very much, Chris. I think that's a great place to leave our conversation. Truly learned a lot. Thank you very much.
Cool. Thanks, Ethan.